In this week's update, we are heading for an opportunity to make exceptional long-term returns. But first, some rough weather. And where are the safe havens? My name is Garry Davis. As always, this is general advice, and please remember to like and subscribe to the video. It's been an awful lot happened this week, particularly at the index individual stock level. In America, we've had some very substantial wins and some very substantial losses. So let's start with a market perspective. And last week I said that the divergence that we're going to see in the market, in fact I've been saying this for quite some time, but I just reminded everybody that the divergence is going to be very, very stark. It's going to be quite breathtaking. And what we saw during the week, if you want to compare Facebook, PayPal and Netflix, and to a degree Amazon, which sort of sits in the middle, and I'll explain why when I get to that point. And if you want to compare that with some of my favourite growth stocks, Blackstone, Google, Visa, Apple, Microsoft, etc., the divergence certainly, even at that large cap level, is quite extraordinary. Now, I think the most important thing you need to do because of this divergence, you need to be taking your cues from the individual stocks that you own or that you're targeting, and not be taking your cues from the index, because it's probable that the index is going to be somewhat misleading for most people's portfolios. Some stocks are going to bottom well before the indices, and they're going to rise, particularly some of the smaller mid-cap stocks, are going to rise multiples from their correction lows before most people are even aware that it's happening. So that's the dynamic that's going on underneath, and it's really never been more important to have an open mind as to what you own and what you're targeting, and be ready to pull the trigger when the right stock opportunity comes along. So you've got to know what it is you want to buy from a fundamental point of view, and then you've got to have an idea of what the entry price is that you're prepared to pay. So never more important. What are the risks out there? Because there are considerable risks apart from a reset in valuations in the market. One of the biggest risks, of course, is geopolitics. We've got the Ukraine situation, which could deteriorate at any moment and have an unpredictable effect on the market. We've also got Taiwan, which hopefully is in the background for a little while. It seems to most commentators that understand these things that we've got a stalemate between Russia and America. Neither Putin or the US can afford to back down, and so I don't know how it gets resolved, to be honest. I can sort of see Russia's point. I guess the aggression route is not the way to resolve it, but you can sort of see Russia's point in terms of encroachment of NATO on their borders, or the possibility of that happening. So I honestly don't know how this gets resolved. I don't think either side is going to back down, and we're probably just going to have a period of ongoing tension. Hopefully that's as bad as it gets. And of course, in the background, we've got China watching with great interest to see what America does. And there's also other hotspots in the Middle East. Not the least is the UAE. So there's lots of geopolitical risk in the market at the moment that could shift it quite dramatically. But having said that, geopolitical risks really don't have a lasting impact on the market. It tends to have short-term sentiment impacts on markets, but not long-term. In fact, often the outbreak of war signals the bottom of the market. Not all the time, but often. Now, the second big risk, and this has been a risk for some time, is central bank policy error. And we saw Jerome Powell make a major error in September of 2018, when he, not only his actions in raising rates, but his rhetoric around that, and it just absolutely frightened the pants off the market, and we saw a substantial fall in markets for 3 months until Powell was forced to reverse his decision or reverse his policy. And it's very possible that the US Fed could make another policy error this time round, with the inflation numbers getting obviously lots of attention. So that's another risk, and these are unpredictable impacts on the market. But overall, the easy money has been made. Coming out of the COVID crash, there was an enormous resurgence in 2020. Large caps, small caps, didn't matter. Pretty much the tide lifted all those boats because they were coming off panic lows. That easy money has been made. It's done and dusted, so we've got a very different environment now. So the sort of stocks that we need to own must have secular tailwinds. So long-term tailwinds built around mega trends, built around societal trends, things that are going to go on regardless of central bank policy or wars or economics or whatever it might be. So I think the areas you should be fishing in are stocks that have got those secular tailwinds big time. They also need to have strong and highly probable growth now, because we've seen in the last week examples where stocks that are in those megatrend areas that have got these secular tailwinds, but when they throw in a less than expected result and they're coming off high multiples of PE or revenue, then they get absolutely slaughtered. And we've seen Netflix down 20%, we've seen Facebook down 26%. The market reaction is absolutely brutal. So your own individual process, how you go about selecting stocks, how you go about entering them, how you go about managing them and taking profits, has never been more important than it is right now, because not only do we have all these issues with inflation and rising interest rates, but we've got all these geopolitical issues as well. So this is going to be a year of tremendous opportunity. I'm convinced of that, but it's also a year of tremendous danger. If you get your stock wrong or you get your timing wrong, you can do a lot of financial damage this year. So you really need to be sorted out in terms of your process. Now, if we look at American stocks, or before we go there, let me look at a few examples. First chart I want to show is a chart that I don't show very often, but it's one that I look at every single day. It's HYG, which is basically the high yield bond fund, and you can see that it's being sold. High yield bonds are being sold off, and you can see that when it does start to roll over and break support, this is the COVID crash. This is what happened during the COVID crash. Then we managed to work our way back up to this sort of mid-80 area, but clearly the high yield bond market is being sold. That means yields, high yield bonds are rising. And if this happens too quickly, if this falls too quickly and junk bond yields go up too quickly, it causes enormous pain for companies in terms of their refinancing, particularly some of the small and mid-cap companies. And that can cause an enormous amount of disruption in the stock market. So that's the relevance here, that this can spill over into the stock market in a significant way. So that one's not looking good. As I said before, what you own has never been more important. How you manage it has never been more important. And the environment we had in 2020, which was a tide that lifted all boats, that is now gone. Now look at PayPal. PayPal peaked in July of 2021 at $310. We're now at $126. Now, a lot of that correction has happened, but it's been extremely dramatic. Once the breakdown happened in October, this has moved a long way. It's halved since October. And you can see huge gap down on Wednesday, and didn't bounce with the rest of the market on Friday. Let's look at Netflix. Netflix got absolutely murdered on the 21st of January. Had a bit of a bounce, which was a bit of a relief rally, probably some short covering. That occurred earlier in the week when something similar happened across the market in the US. But look, it failed to rally last night. And last night's rally, frankly, at the index level is highly suspect, and I'll explain why in just a minute. Look at Facebook. Facebook down 26% on Thursday night. Facebook is in serious trouble as a business, not just talking about the share price. Facebook has, I think, is significantly weaker stock than the majority of people understand that it is, and I think it's highly likely that Facebook is going to fall a great deal further from here. And if you look at the charts of PayPal and Netflix and a number of others, it's it's not hard to see why that could happen or how that could happen. So Facebook, that was very ugly. Now this is one that really shocked me this morning. This is Clorox. Clorox is one of the world's global consumer staples makers. This is all the everyday stuff that you buy in the supermarket. This would have been right up there with the most stable companies in the market. Now clearly it's been on the slide since August of 2020, where it was trading at around $240. We then have been basing recently at about 165, but look at the result. They were down 10% overnight. This is a $20 billion consumer staples global giant, but they have warned about the retail environment. This is a hugely meaningful chart. This is not a stock that I track at all. Probably the last time I looked at it was probably about 2 years ago. So I was staggered to see this chart today, and this really presents a serious concern for the US market. Now let's look at the Amazon result. Now Amazon, let's look at the numbers first of all. So overnight, on Thursday after market, they reported earnings of $27.75 versus an expected $3.89. So on the surface, that looks like a fantastic result. But in that was the realisation of a one-off investment, a stock or a part of their business that I think they floated off. So that's a one-off boost. So that comparison to expectations is nowhere near correct. The next thing is that almost all the profit was from the cloud, from their cloud business. Now, on the one hand, that's good because that's where the growth is. But there was almost no contribution to profit from the retail business. Now, Amazon, up until 5 or 8 years ago, that was all they were. They were a retailer. It's a wonderful business. But retail is making almost no contribution to profit, is making a contribution to sales, but not to profit. So almost all of it is coming from the cloud. So that's a bit of a worry. And that is consistent, the fact that their retail business is just not contributing is consistent with what we saw on the previous chart from Clorox. Now, if we look at it technically, we broke down very sharply on the 20th and 21st of January. We had a big pop on Monday, which I'm convinced was merely a short covering rally from oversold. We then had a pretty mixed session on Wednesday, a really negative session, huge gap down, a really negative session on Thursday. And then we got this 14% jump on Friday night. But all it's done is brought it back to the breakdown level. Closed well off its highs. And you've got to step back and look at the price chart. So I'm not getting excited at all about the 14% Amazon rise. Look at all the moving averages. They've all rolled over. All the shorter moving averages are now pointing down. Even the 200-day moving average is pointing down. Now, for anyone that has followed what I do for any short period of time knows that my fundamental orientation is bullish. Some would argue, and I've been accused in the comment section of being, a perma bull. And I make no apologies for that because long-term markets go up, and long-term, I think if you don't have a bullish outlook on life, it's a pretty sad way to go. So my orientation is bullish. So I find no joy at all in making these observations. And if anything, I'm going to tend to find things that look bullish because, that's how my brain is wired, to look for things that are bullish. But I've got to tell you that I'm finding so many bearish signs all over the place that you've just got to call it for what it is at the moment. So the shift that I've made this year, which was sort of, dipping my toe in the water in December, saying, look, things aren't right, the growth versus value spread charts are rolling over, and I've ramped up that message since December, and I'm seeing nothing, despite the rally on Monday in the US and despite the rally last night, I'm seeing nothing that changes that view that we're in for several months of pretty rough market. Now on the other side, and I just flicked through these charts because I covered these in detail last week. You look at Blackstone, 200-day moving average still heading up, the business going along beautifully, the price looking extremely robust. Apple, price still looking very robust. Microsoft, the same, 200-day moving average still pointing up, price still above it. Google came out with fantastic results, and these really were good, as opposed to Amazon's that I think are falsely good. Google had a huge gap up. Let's look at the mid caps. This is MDY, so the S&P Mid Cap 400 index has broken support. Now we've rallied back to support, but closed well off its highs on Friday night. So nothing special going on there either. The S&P, for the record, gained 1.5% for the week, but I'm still of the view that the high of the bounce is likely to now be complete. It may not. It's possible some sort of positive, we're still in earnings season, some other positive result might come out which will drag the indexes up higher, but there's no question that what is sitting under the indexes, the broad scope of the US market, is pointing down, and is pointing down quite badly. I mean, I don't have time for it in this forum, but I could show you 100 charts that look, extremely ugly. So irrespective of what the index does, I think the US market looks to be in trouble. And retail particularly, it just looks downright ugly. And you can look, if you look at XRT, that's a very diversified retail exposure. That looks pretty nasty. Now the US dollar was lower to 95.48. I guess that's perhaps a bit of a reflection that some people think that the Fed will now not have to raise rates as many times as they were been thinking. The 10-year yield shot up to 1.93. So I don't know what's going to happen when this yield gets above 2%. I think that's going to be a big psychological level for the market. If we start trading with a 10-year yield with a 2 in front of it, I don't think that's going to go down too well. The VIX has been sustained in a range from 21 to 28, and that is high. And this is doing exactly what I said last week or the week before, whenever the VIX spiked to 38. I said that I believed that we would get a sucker rally, if you like, a counter trend bounce from oversold. The VIX would drop back down into the low 20s. And then as we rolled over, we'd get another spike in the VIX. So far, this is playing out exactly as it normally does, entering a cyclical bear market. I'm not seeing anything at all that suggests otherwise. Okay, here's the VIX. So this is the VIX over the last 5 days. So you can see we had a low of 21 and a high up there at 28. If you look over the last month, you can see whilst we had a big peak here on the 26th of January, we're certainly still at an elevated level in the low to mid-20s is elevated, no matter which way you want to carve it. So let's take a look at the S&P just for the record. So here's our bounce. We've bounced to between the 20-day and the 50-day moving averages, which is often what happens with the S&P. And we rolled over quite sharply on Thursday. And look, honestly, if it wasn't for Amazon, we would have been down last night or overnight on Friday on the S&P. There's no question. Amazon going up 14% made a very significant contribution to the S&P being up, and also to the Nasdaq being up. But I fully expect that we're going to see this level around 42.30. Going to see that level break, and we're going to head towards the 3,800 level. Not predictions, but gee, all the tea leaves are pointing that way. So this is the Nasdaq. Again, take out Amazon, and you're down on the Nasdaq for sure. And I think a 14% bounce in Amazon was just not warranted by the results. And this is IWM. Clearly, we are now in downtrend. We haven't even been able to rally back to the breakdown level. All the moving averages have rolled over. So really quite a negative scenario. I just want to look at the spreads as well before I move on. So let's look at the various spread charts which really tell a story, and bear in mind that on some of these charts, the Amazon result last night is sort of muddying the waters, but I do not believe that price jump in Amazon will prove to be sustainable. Certainly it had an impact there. This is growth small caps versus value small caps. So clearly we're heading down. This is the Russell 1000 growth versus value. Little bit of a bump last night, but still quite sharply down. This is consumer discretionary versus consumer staples. Now, I'm betting that this has kicked up quite a bit. One, because Amazon went up. I'm not sure whether it gets any classification in consumer discretionary at all, whether it gets any weighting in that index. But certainly the Clorox, which would be in the consumer staples section, that falling would have contributed to the ratio rising. But I think I would expect this support level here to break. Let's just put it that way. Okay, let's turn now to, I think everyone's getting the message by now. And again, let me repeat, I find no joy in being bearish. I hate it, but I've got to call it for what it is. This is the US dollar index. So we moved up quite sharply the week before, but certainly came off the boil last week. And as a consequence, the Australian dollar had a bit of a rise. I guess it's pretty much in line with what the US dollar did in reverse. But we finished at 70.16. So from my perspective, last week I said that the direction is down. The next target level is probably around 67.5. Moving on to the Australian market, 70.16 is where we finished. Our index gained 1.9% for the week. There was across the board buying. Materials did well, energy did well, finance did okay, healthcare bounced back a bit. Even the small cap index did all right. But I just don't believe at the index level we're going to see this. We're going to see this continue. Okay, so we'll go to the. Let's look at the ASX 200 first of all. So we've broken down support. We're rallying back to it. I'll be surprised if the Australian market opens up on Monday. I would fully expect the Australian market to open down. But look, who knows? It might go up a little bit more. But I think we've broken support. We're now clearly below the moving averages. The moving averages are starting to roll over, and I think that's where our index is heading. There is the materials sector, so BHP and Rio did really quite well towards the end of the week. There's small caps. So small caps did all right last week, bit of a surprise. Healthcare, quite a nice bounce from heavily oversold. Finance, not a lot of movement there. Energy still continuing to do well. Okay, so that's the situation with the US market. Let's look at Bitcoin. Bitcoin's been a very sad story since 68,000. We got all the way down to 32,500. Nice break on Friday. Whether that has anything to do with the Amazon result or not, I don't know. But certainly that was a bit more of a risk-on move in Bitcoin. But looking at gold up a little bit. If we look at the weekly though, it's just stuck. It's just not going anywhere. And silver is very much the same. And if we look at GDXJ, we're just again stuck at the bottom of the range. There's not much more I can say about it. Okay, 1809 is where we finished, and I just don't see what's going to get gold going up unless we get an outbreak of war in the Ukraine. I reckon that's probably the best possibility at the moment. Turning to other commodities, copper was up to 446, nickel rebounded to 1062. We had an overreaction last week because of a shipment of nickel out of Indonesia using a new technology. But, you know, that one-day plunge in nickel always looked a bit suspect. But crude oil, 92, it's just absolutely rocketing. And if you're hurting at the petrol pump, don't expect it to improve. I think it's almost certainly going to get worse in coming years. It's hard to see with the underinvestment already in oil exploration. It's really starting to bite. That's not going to change. And the demand is not coming off quick enough to compensate for the fall in production. So you can really only see the oil price continue to head further. So I don't know that we're going to get any relief at the petrol price level. Sad to say, I'm a cheery little fellow today, aren't I? There's spot copper, nickel, nice rebound. So wrapping things up, for the market to establish a meaningful low, you know, and I think it would be incredibly unlikely that this is going to be another quick buy the dip. Now, I know that we've been conditioned for most of the last 4 or 5 years, we've been conditioned to short, sharp declines, and then, you know, you buy the dip and off it goes again. There are enough signs now that that's not going to happen. And this time round, we're due now for a more significant correction. And the reason for that is because interest rates have turned the corner on a 40-year bear market in interest rates. So in that scenario, to establish a meaningful low in the market, there's got to be a reset of sentiment. The majority of people have got to turn bearish. You don't get lows in a cyclical bear market just by some selling, while everyone, sort of stays fundamentally bullish, but they just step back and the prices fall. In a cyclical bear market, that's not enough. It has to be more than that. The majority of people have to turn bearish. So there's got to be a sentiment reset before we see the lows, and we're not getting that yet. And there also needs to be a valuation reset. So many companies were trading on massive multiples of earnings and sales without earnings that reset has to occur, and I don't think that reset has played out yet, because there's still some stocks. I mean, we saw Facebook and Netflix drop, very, very significantly, PayPal. So, clearly there's a lot more pain to come in those high growth stocks. And I think if interest rates go above 2% in the near term, then, we're going to see that play out. So don't expect a meaningful low until we see those resets. Now, for anyone that wants to, sit back and just stay long, stay reasonably fully invested and just ride it out, that's fine. But just recognise that the vast majority of people, and I've worked directly with traders for 20 years, so I know how people think and I know how they act in the extremes. If you want to stay long, then you want to be damn sure that you're not going to be one of the majority of people who throw the towel in at the bottom. It's easy to say you'll stay long when the market is not that far off its highs. And where we are at the moment, we're not that far off the highs. We're only 250, 300 points off the highs in the US. It's not that much. So you want to be damn sure if you're going to stay long, you want to be sure that you're not going to be like most people and just get panicked when the media turns negative and everybody's negative and bearish and you toss the towel in at the bottom. Now, I think all stocks are going to have headwinds to a degree until this correction is complete. But some stocks are going to bounce much, much sooner, way before the index lows are formed. And they probably bounce back pretty readily to new highs. So they're the stocks that you need to focus on. Portfolio analyst last week, it was a skills development session, which the membership is embracing. I think it's going down really well. And I'm loving doing it. So that was a very productive session in Portfolio Analyst last week. So that's all I've got for you this week. There's more information on the website. There's my email address. I think we're in for just a series of volatile and fascinating weeks if you're positioned in a relatively neutral fashion, so that whatever the market does, it doesn't hurt you too much. I don't believe there's going to be very much in the way of upside that you're going to miss out on if you're in a heavily cashed position. But if you're in a heavily cashed position, I think you're going to miss out on quite a bit of downside. So sorry about the bearish message, but that's the way it is. And I'll be back with you next Sunday. Cheers.